Stop everything you're doing right now, because what just happened in silver isn't just another headline. It's not just another record. It's not just another number flashing across your screen that you scroll past while checking your portfolio. What happened today is the kind of move that separates the people who build generational wealth from the people who watch generational wealth get built by someone else. Silver didn't just break through $110 an ounce. Silver exploded through it. And the way it happened, the timing, the velocity, the forces pushing behind it, that tells a story that most people will completely miss. A story that you need to understand before Wednesday, before the Federal Reserve steps up to the microphone, before the next domino falls. If you're holding silver right now, if you're thinking about buying silver, if you've been watching from the sidelines wondering whether you missed the boat or whether the boat is just leaving the harbor, this is the video that could change how you see the next 12 months. Because I'm going to walk you through exactly what triggered this move and why it's different from every rally that came before it. I'm going to show you what the dollar's collapse is really signaling and why intervention talk is making traders sweat through their shirts. I'm going to explain why the Federal Reserve meeting this week might matter more for silver than any Fed meeting in the last decade. And then I'm going to tell you the one mistake that is going to wipe out portfolios this month, even portfolios that got the direction completely right, even portfolios that are sitting on massive gains right now. Because being right and staying right are two completely different games, and the market is about to test everyone. Before we dive in, I need you to do me a quick favor. Look at the subscribe button right now. If you're watching this channel regularly, if you're getting value from these breakdowns, if you're using this information to make better decisions, and you haven't subscribed yet, now is the time. We're pushing hard to grow this community because the bigger the Financial Crux family gets, the more resources I can pour into research, into data, into bringing you analysis that you cannot find anywhere else. Your subscription costs you nothing, but it means everything for what we're building here. Hit subscribe, hit the notification bell, and let's get into what just happened. $110.06. That's where silver touched this morning before pulling back slightly to trade around 109. Now I want you to understand something. This isn't just a round number. This isn't just a psychological level that traders watch because it looks nice on a chart. This is a level that 3 years ago, 2 years ago, even 12 months ago, most analysts would have called you delusional for even mentioning. Go back and look at the predictions from late 2024. The consensus was that silver might, if everything went perfectly, push toward $40 or $50 by the end of 2025. The idea that we would be sitting here in January of 2026 watching silver trade above $100 was considered fantasy. It was considered the kind of thing that only the craziest silver bugs believed. And yet here we are. But here's what matters more than the number, the speed. Silver has surged more than 250% over the past 12 months. 250%. Let that sink in for a moment. If you had put money into silver 1 year ago, you would have more than tripled your investment. But that's not even the crazy part. In January alone, silver has jumped 50%. 50% in 1 month. This isn't normal price discovery. This isn't a market calmly repricing an asset based on new information. This is something else entirely. This is a market that has shifted into a completely different mode. And when markets shift into this mode, they create opportunities that most people never see in their lifetimes. They also create dangers that can destroy you faster than you ever thought possible. So what's actually driving this? Let's start with the most obvious force, the dollar. Because if you want to understand why silver is exploding, you have to understand that silver isn't just going up. The dollar is going down. And it's going down in a way that is making some very powerful people very nervous. The dollar index, which tracks the greenback against a basket of major currencies, just dipped to a 4-month low around 97.16. Now, if you don't follow currency markets closely, that number might not mean much to you. But let me put it in context. When the dollar weakens, commodities priced in dollars become cheaper for everyone outside the United States. That means a buyer in China, a buyer in India, a buyer in Germany can suddenly afford more silver for the same amount of their local currency. That creates a demand surge that feeds on itself. The weaker the dollar gets, the more attractive silver becomes to international buyers. The more they buy, the higher the price goes. The higher the price goes, the more headlines get written. The more headlines get written, the more momentum chasers pile in. It becomes a feedback loop. And that feedback loop is running hot right now. But here's where it gets really interesting. And this is the part that should make you sit up straight in your chair. Reuters reported that the New York Federal Reserve reached out to dealers on Friday to check on dollar-yen exchange rates. Now that might sound like boring central bank housekeeping. But in the world of currency markets, that kind of call is a signal. It's often viewed as a precursor to intervention. It means someone at the Fed wanted to know exactly what was happening in the market. It means they wanted to understand the positioning. It means they're watching closely enough to pick up the phone. Dominic Bunning at Nomura called this a more powerful driver than most people realize, because when intervention talk starts circulating, it changes behavior. Traders who were comfortable being short the dollar suddenly get nervous. Traders who were waiting on the sidelines suddenly see an opportunity. And the yen, which has rallied to around 153 against the dollar, becomes a tell, a signal that big money is repositioning. Now layer on top of this the geopolitical chaos that's been building for weeks. President Trump just threatened a 100% tariff on Canada. 100%, that's not a negotiating tactic. That's economic warfare. And it's linked to ongoing tensions around China trade deals that seem to change direction every other day. Heraeus Metals trader Alexander Zumpfa warned that this kind of environment can trigger sharp interim corrections. He's right. When you have geopolitical uncertainty at this level, when you have currency markets this volatile, when you have central banks potentially preparing to intervene, you get price action that doesn't follow normal rules. You get moves that look irrational until you realize the players making those moves have information you don't have. They have positions you can't see. They have motivations that go far beyond what shows up in the headlines. And then there's the Federal Reserve meeting, starting Tuesday, ending Wednesday, with a statement due at 2 o'clock Eastern and a press conference at 2:30. Now, normally I would tell you to focus on the rate decision. Normally that's what matters. Will they cut? Will they hold? What does the dot plot say? But this time, according to Reuters columnist Mike Dolan, the focus might shift somewhere else entirely. The focus might shift to the political drama surrounding Fed independence, to the possibility that President Trump could name a successor to Chair Jerome Powell during the session itself. Think about what that would mean. In the middle of a Fed meeting, while the world is watching to see what happens with interest rates, the president could announce that he's replacing the most powerful central banker on the planet. That's not a monetary policy story. That's a crisis of confidence story. And Kyle Rada at Capital.com just described the entire move in metals as being driven by exactly that, a crisis of confidence in U.S. leadership and U.S. assets. When confidence breaks, money moves. It moves out of paper. It moves out of promises. It moves into things you can hold, things that don't depend on a government keeping its word, things that don't depend on a central bank maintaining its independence, things like gold, things like silver. Gold just pushed past $5,100 an ounce for the first time in history. That's a 60% gain in 2025 alone. But even gold's performance looks calm compared to what silver has done. And that difference is important because it tells you something about the nature of these two markets and the role they play right now. Gold is the steady hand. Gold is the asset that central banks accumulate when they want to diversify away from the dollar. Gold is what institutions buy when they need a store of value that will still be recognized 100 years from now. Gold moves with purpose. It absorbs huge flows of capital without breaking a sweat. Silver is different. Silver is the lightning bolt. Silver is what happens when fear meets scarcity, meets speculation, meets momentum all at the same time. Silver doesn't walk anywhere. Silver runs. And when it runs hard enough to scare everyone, including the people who are making money. Now let's talk about fundamentals, because this is where the story gets really compelling. Silver isn't just a safe haven. It isn't just something people buy because they're scared. Silver is an industrial metal, and not just any industrial metal. Silver is one of the most important conductors of electricity on the planet. It shows up in electronics. It shows up in solar panels. It shows up in circuit boards. It shows up in the energy infrastructure that every country on Earth is racing to build. According to Metals Focus, industrial demand now accounts for around 60% of total silver consumption. That's up significantly from where it was a decade ago. What that means is that silver has become tied to the biggest investment themes of the next 20 years: electrification, renewable energy, the rebuilding of grids and supply chains. Every solar panel needs silver. Every electric vehicle charging station needs silver. Every data center powering the AI revolution needs silver. This isn't speculative demand. This is real demand from real industries that cannot substitute something else without massive costs and delays. And here's the supply side of the story that almost nobody talks about. Roughly 3/4 of new silver supply comes as a byproduct of mining other metals: copper, zinc, lead. Silver miners don't control how much silver gets produced. Copper miners do, zinc miners do, and those miners respond to copper prices and zinc prices, not silver prices. So when silver demand surges, supply doesn't magically increase to meet it. Supply responds slowly. Supply responds reluctantly. Supply is constrained by decisions that were made years ago about which mines to build and which deposits to develop. The result is a market that has been in deficit every single year since 2018. Last year's deficit reached nearly 20%. And another shortfall is expected in 2026. You have demand accelerating and supply stuck in neutral. That's not a recipe for lower prices. That's a recipe for exactly what we're seeing. But now I have to give you the other side, because if I only told you the bullish story, I wouldn't be doing my job. And the other side of this story is speculation. The silver market has a total value of roughly $5.3 trillion. That sounds like a lot until you compare it to gold's $33 trillion footprint. Silver is a small market. Small markets move faster. Small markets get pushed around more easily. Small markets attract speculators who know they can move price with concentrated bets. And right now, speculative positioning has become a dominant force. Intraday swings of several dollars within minutes have become common. Think about that. Several dollars in minutes on a commodity. That kind of volatility shifts hundreds of billions of dollars in market value in short bursts. Traders who are used to normal commodity cycles, who are used to watching prices drift slowly over weeks and months, are finding themselves in a market that behaves like a high beta tech stock. That creates opportunity. It also creates danger, because here's the trap. When a market moves this fast, everyone feels like a genius. You buy silver at 90, it goes to 100. You feel smart. You buy more at 100. It goes to 110. You feel like a legend. You start using leverage. You start sizing up. You start telling yourself that this is easy and you should have done this years ago. And then the market does what markets always do. It reverses without warning. It drops $15 in 2 sessions. It triggers margin calls. It forces you to sell at the worst possible moment. And while you're selling, while you're panicking, while you're watching your gains evaporate and turn into losses, someone else is buying. Someone with deeper pockets. Someone who was waiting patiently for exactly this moment. Someone who understands that the shakeout is not the end of the rally. The shakeout is how the rally transfers wealth from weak hands to strong hands. I see this pattern over and over again in precious metals. I've seen it in gold. I've seen it in silver. I've seen it in mining stocks. The pattern is always the same. Price runs, retail piles in, leverage builds, something triggers a reversal, could be a margin hike, could be a headline, could be intervention, could be nothing more than profit taking by a few large players. And then the cascade begins. People who bought with borrowed money are forced to sell. Their selling pushes price down. The lower price triggers more margin calls, more forced selling, more downward pressure. And the whole thing feeds on itself until the leverage is cleared and the market can breathe again. That's why I keep saying that the most dangerous moment in a bull market is when everyone agrees it's a bull market. When everyone is bullish, there's no one left to buy. When there's no one left to buy, the only direction is down, at least temporarily. And if you're positioned wrong when that temporary reversal hits, you don't get to participate in the next leg up. You're already gone. You've already been shaken out. You've already handed your position to someone with more patience and more capital. So how do you survive this? How do you stay in the game when silver is moving 10% in a day and headlines are screaming and your emotions are telling you to do something? Here's the framework I use. And I want you to write this down or screenshot this because it could save you from making a very expensive mistake. First, know who you are. Are you a trader or are you a stacker? Those are different games with different rules. If you're a trader, you respect volatility. You use stops. You size your positions based on what you can afford to lose, not based on how much you want to make. You accept that you will be wrong sometimes and you plan your exits before you enter. If you're a stacker, if you're accumulating physical metal or long-term positions for a multi-year thesis, you think completely differently. You expect pullbacks. You welcome pullbacks. You see a 15% drop as a buying opportunity, not a disaster. You don't check the price every hour. You don't panic when you see red on your screen. You've made peace with volatility because you understand that volatility is the price of admission for the kind of returns silver can deliver. Second, watch the right signals. Most people watch price. Price is a lagging indicator. Price tells you what already happened. If you want to anticipate what's coming next, you need to watch the signals underneath price. Watch the spread between spot and futures. In a normal market, futures trade above spot because of carrying costs. When that relationship inverts, when spot starts trading above futures, you're seeing urgency. You're seeing buyers who want metal now and are willing to pay a premium for it. Watch lease rates. What does it cost to borrow physical silver? If lease rates are spiking while paper prices are getting hit, that's a tell. That's the market saying physical is tight even if paper is getting sold. Watch premiums in major physical markets. If Eastern buyers are paying $5 or $10 above the paper price to get actual metal, that divergence matters. That divergence tells you the paper game and the physical game are not the same game. Third, manage your leverage. This is where most people blow up. This is where smart people with correct theses still lose money, because the exchange can raise margin requirements whenever it wants. It can change the rules overnight. It can make a position that was comfortable yesterday into a position that requires you to post more cash or get liquidated today. If you don't have the cash, you don't get to hold through the dip. You get forced out at the exact moment you should be holding. This is not theoretical. This is what happens every single time silver makes a major move. Every time, the margin requirements go up, the weak hands get flushed. And the people who survive the flush are the ones who sized correctly from the beginning. If you're leveraged to the gills right now because you got greedy during the rally, you need to fix that before Wednesday, before the Fed speaks, before the next headline hits. Because the headline always comes when you least expect it. Now let's talk about what could trigger the next big move in either direction. Wednesday is obvious. The Federal Reserve decision is the most watched event of the week. But like I said earlier, the decision itself might matter less than the theater around it. If President Trump announces a Powell replacement during the meeting, all bets are off. That would be interpreted as an attack on Fed independence. That would send a signal to every investor on the planet that the rules are changing. That would accelerate the flight from dollar assets into real assets. Gold would surge. Silver would surge harder because silver always surges harder. On the other hand, if the Fed surprises with hawkish language, if they push back against rate cut expectations, if they signal that they're more worried about inflation than growth, that could temporarily strengthen the dollar and create a pullback in metals. I'm not saying that's likely. I'm saying it's possible. And possible is what you need to prepare for. The tariff situation is another wild card. 100% tariffs on Canada. Ongoing China uncertainty. The administration clarified that tariffs on silver and other critical minerals are off the table for now. That's important because it removes one potential headwind. But the broader trade war narrative is creating exactly the kind of uncertainty that drives capital into precious metals. Every escalation, every threat, every retaliation feeds the safe haven demand. And right now, there's no sign of de-escalation. There's no sign that anyone is backing down. There's every sign that this is going to get messier before it gets cleaner. Then there's the intervention question. If the Fed or the Treasury or their counterparts in Japan actually intervene in currency markets, that would be a huge deal. Currency intervention is a blunt instrument. It signals desperation. It signals that normal policy tools aren't working. It sends a message to the market that governments are willing to manipulate exchange rates directly. And every time that message gets sent, a certain percentage of capital decides it wants out of fiat currencies entirely, permanently. That's capital that ends up in gold, in silver, in assets that can't be printed by a central bank. The intervention talk right now is just talk, but the fact that the New York Fed is making calls, the fact that dealers are being asked about positioning, that tells you the conversation is happening at the highest levels. I want to give you one more thing to think about before we wrap up, and this might be the most important part of everything I've said today. The nature of the buyers in this rally is changing. A year ago, silver was moving on speculative flows, hedge funds, momentum traders, people chasing price. That crowd is still here, but now there's another crowd showing up. Industrial buyers who need silver for production. Sovereign entities building strategic reserves. Long-term allocators who see the supply-demand picture and are positioning for the next decade, not the next week. These buyers behave differently. They don't panic. They don't watch candlestick patterns. They don't care if silver drops 10% because they're not measuring performance by the month. They're measuring security of supply. They're measuring long-term value. And when those buyers show up in size, they create a floor underneath price that speculative selling can't easily break through. That's the setup we're looking at right now. You have speculative froth on top. You have structural demand underneath. You have a currency crisis accelerating in the background. You have a central bank that's about to make a decision while its independence is being questioned. You have geopolitical chaos on multiple fronts. And you have a metal that has been in supply deficit for nearly a decade and shows no sign of that changing. All of those forces are colliding this week. Something has to give. And when it gives, the move will be violent. So here's my question for you, and I want you to answer this in the comments because I read every single comment and I want to know how this community is thinking. Do you think silver pulls back hard before the next leg, or do you think we're going straight to 150 without stopping? Think about it. Actually think about your reasoning and drop your answer below. Also, if you've had success with silver or gold, if you caught any part of this move, if you made a decision that worked out, share your story in the comments. Not to brag, to help. Because when someone else sees that a regular person, not a hedge fund manager, not an institutional trader, just a regular person watching YouTube videos and making smart decisions, when they see that person succeed, it changes what they believe is possible. It changes their own behavior. It creates momentum in this community that helps everyone. All right, let's bring this home. Silver just broke 110. Gold just broke 5,100. The dollar is in free fall. The Fed meets in 2 days, and the president might fire the Fed chair during the press conference. If that sounds like a normal week to you, you haven't been paying attention. This is not normal. This is a turning point. And the question you have to ask yourself is whether you're positioned for what comes next, or whether you're going to spend the next 5 years wishing you had paid closer attention when the signals were this clear. I'm not telling you what to do with your money. That's not my job. My job is to give you the information, the framework, the context that helps you make better decisions for yourself. And what I'm telling you right now is that the next 72 hours could matter more than the last 12 months. Watch the Fed, watch the dollar, watch the premiums, watch the lease rates, and most importantly, watch your own behavior. Because the market tests psychology more than it tests analysis, and the people who win are the people who stay calm while everyone else panics. Subscribe if you haven't. I mean it. Hit that button. The Financial Crux family is growing, and I want you to be part of what we're building here. This is going to be the most important year for precious metals in a generation, and I want you here for every step of it. I'll see you in the next video. Until then, stay sharp, stay patient, and remember, the biggest gains go to the people who were prepared before the crowd figured out what was happening. That's you. If you're watching this, that's you.